Hey everyone, in this video I'm going to do a quick analysis on Amazon stock and do an intrinsic value calculation using a discounted cash flow analysis. I was a bit surprised to learn that Amazon is actually at a pretty significant 52-week low. They're down around 13% since last year, and year to date they're down about 14% as well. At least as of the recording of this video, we'll see what happens when this thing actually posts. But with this pretty significant move down, I wanted to go ahead and take a look to see if it's worth adding to my portfolio. Let's go ahead and do a quick analysis on Amazon. So here's Amazon stock. As I mentioned, it's down about 13%, 12.5% or so since last year, and year to date, it is down about 14.5%. So not a good way to start the year for current shareholders. And in case you didn't know what Amazon is, they're a super large retailer that is slowly taking over the world. And they have a number of sub businesses in addition to their main e-commerce business. You have Amazon Web Services, they own Whole Foods, and a bunch of other things. But I think the best way to describe Amazon quickly is as a low-cost retailer focused on distribution, but also with a pretty significant side business of providing cloud infrastructure. It's currently worth in market cap terms a $1.4 trillion valuation. And this is quite a bit lower than where it's been pretty recently, but still a very large valuation. But as with every company, the first thing I like to do is taking a look at the balance sheet. We'll switch over to quarterly and see what they're working with right now. We'll take a look at cash and we see that they have about $30 billion in cash. And when you add that cash to their short-term investments, I'm not really sure what those would be since typically cash and equivalents includes things like short-term treasuries. So I'm not really sure what short-term investments is, but when you add those together, they're looking at around $80 billion in cash and short-term investments. We can scroll down and compare this to their debt, starting with their long-term debt. They have about $55 billion there, more like $56 billion. I'm sure this not only includes their warehouses for distribution, but also their data centers and any Whole Food stores and all the real estate that they have interest in, whether they own it or not. But in this case, it'd be what they've leased. But they have $63 billion in leases on the books. Now I'll take a quick look at their total shares outstanding to see if we're seeing any dilution, which is where the company issues new shares so that all existing shareholders effectively have a smaller share of the business. And if you are a shareholder, dilution is not something you want to see because that means that your individual share is inherently worth less because there are more of them out there. It's sort of like inflation, but in stock terms. The opposite of this would be buying back shares, where the company is actually acquiring its shares and taking them off the market so that now each individual shareholder would have a larger share of the business and its profits. With Amazon, it looks like over the last couple of years, because I'm in the quarterly view, they've had a little bit of dilution, not too crazy, but it is worth noting. So to review the balance sheet, we don't have a lot of dilution. We have about $30 billion in cash, or if you include short-term investments, more like $80 billion. When you compare that to their long-term debt, it's not the best. You'd like to see them have enough cash to take care of all their long-term debt in one fell swoop if they want to, but that's not what's happening here. It's not outrageous, but do keep in mind they have a lot of leases to worry about, and that's always going to be a pretty significant outflow because they have to be in all sorts of different places. They're not just a software business, and even on the tech side with AWS, they have a significant presence because they are actually setting up these servers. They're setting up these infrastructure systems. I don't know how else to describe them, but you actually need the real estate to put the server somewhere, and that's before we even get into e-commerce with all of the logistical challenges and the tons of warehouse space that Amazon needs. But now let's take a look at the income statement. Hey guys, real quick, if you want to get some free stocks, go ahead and check out the affiliate links to Webull and Robinhood. If you open up your free accounts there, they'll give you some free stocks. I get free stocks as well, so it's a win-win, so go ahead and check those out. It's free money.
It's free real estate.
I've switched this to an annual view so we can see more of a general trend. Let's take a look at the top line with revenues. They have been growing quite steadily, or really pretty rapidly over the last few years, especially. Let's take it back even further over the last 15 years or so. We're looking at very significant revenue growth. This company has done phenomenal things. And if you look at just the past 5 years, we can see that revenue growth has been around anywhere from 20 to about 37%. That was in 2020. So significant revenue growth even at this size. They're still growing their revenues in big ways. Right now, in the last 12 months, we're looking at about $450 billion in annual revenue. But that's just one part of the equation. Sure, anyone can grow revenues, but if your expenses are growing in huge ways as well, who really cares? What really matters is the cash flow. So we're going to go over to the cash flow statement. This is the lifeblood of the business. Free cash flow in particular is what I like to look at because that is money that the company can do pretty much anything with. They can use that money to pay down debt, buy back shares, invest back into the business, pay out dividends, whatever they want to do. Long-term free cash flow is going to be a very important thing for doing all the great things that businesses aim for. And free cash flow in particular is calculated by taking cash from operations minus capital expenditures. So capital expenditures would be money reinvested back into the business. So what's left over is your free cash flow. So in this chart, you want to see the blue bar being generally larger than the gray bar because that would imply that there is positive free cash flow. In 2020, Amazon had about $26 billion in free cash flow. Compared that to the previous year of, about $22 billion. Compare that to the previous year of about $17 billion. So significant growth in cash flows just over the past few years even. Going back another year, we're looking at about $7 billion in free cash flow. Going back another year, again, looking at about 10. So you see the general trend line up. Except in their last 12 months, if we go down to the chart here, we could see that their cash from operations is actually less than their capital expenditures. So 2021 in particular, they invested a ton of money back into the business to where they actually have had negative free cash flow. This seems like a temporary sort of thing if we're looking at the general trend, but I definitely would want to know a little bit more about what these capital expenditures are, because you can see they're quite a bit higher than the past few years. Before 2019, capital expenditures hadn't been over 17 billion, yet in 2020 they were over 40 billion, and in the last 12 months they've been almost to $60 billion in capital expenditures. They are still in growth mode, so most of it I assume is going towards that, but that is a very significant investment to say the least. Now, one quick note about where Amazon's actually getting its revenue from, because this will be important when we're making growth projections for the company. We can see that about 60% of the revenue is from the North American market. I think this is specifically mostly e-commerce and just retail in general, but Amazon Web Services makes up about 13% of the business, and it has been growing pretty rapidly, at least over the past decade, but it's still a pretty small segment of the business, at least compared to e-commerce, and this last segment here is international. But notably, AWS is much more profitable compared to the retail segment, which is a comparatively low margin business, since AWS makes up over half of the operating income, at least as of the second quarter of 2021. Let's talk a little bit about Amazon's potential avenues for growth, at least in e-commerce as well as in the cloud services space with AWS. So let's take a look at this article from Digital Commerce 360. I pulled this article up because it gives a quick estimate on what market share Amazon has for US e-commerce. And as of Q3 of 2020, so this data is a little bit old, but back then Amazon accounted for 44% of the US e-commerce market during that period. So already have a very large share of the e-commerce market. You wonder how much more of the e-commerce market they could get, as well as how big is this market really going to grow? Because maybe their market share doesn't change, but if the pie itself gets bigger, then you don't really need their percentage of the pie to get any bigger because you're just growing with the whole pie. Well, here's some rough data on worldwide e-commerce. So this is how big the whole pie is if you're looking at the whole world, not just the US. Amazon does skew to the US, obviously. So take it with a grain of salt, but we can see that growth has been pretty steady and quite rapid over the past few years. And they're projecting, looks like what, about 10 to 15% growth per year for the next few years. So maybe that's how big the pie grows worldwide, and Amazon maybe grows at that rate for the e-commerce segment of the business. So maybe that's kind of a rough ballpark number we could start to work with. But they do face increasing competition, especially as many of the big retailers get their e-commerce acts together. Think Walmart, Best Buy, Target, pretty much any big retailer out there, and even small retailers. Any retailer that can make a sale on its own without Amazon is profit that Amazon is missing out on. So we'll see how Amazon does in international markets, because they are very US-centric, like I mentioned. And if they can grow more in international markets, that could be a huge catalyst for the company, but that's going to be very challenging as well. And while we're on the topic, I might as well look at the projections for e-commerce revenue in the US specifically, not just worldwide. And it looks closer to about that 15% year mark, so very similar to the worldwide trend. So maybe that is a good sort of benchmark if you believe these projections, of course. But what about the growth of Amazon Web Services, or AWS? Let's take a look. We can see that they currently have about a third of the market, and have for quite some time now, a number of years. They've had about a third of the cloud services market. This market is dominated by a few big players, with Amazon being one of them, so it's hard to say that they'd be able to grow this share in a big way, especially because it's been so stagnant for a while, but who knows, maybe they can. When it comes to the growth of the cloud computing market, if we believe this report that Yahoo cites, they're guessing about a 16% compounded annual growth rate over the next 5 years or so, or about 40 years from now. So maybe this is a reasonable benchmark to go off of. I don't really know how reliable this data is. In any event, it's trying to tell the future, so you never really know what's actually going to happen, but maybe this 16% number is pretty accurate, so we'll use that for our projections. So even if Amazon's share of the market doesn't grow, if the entire market grows at 16% per year, well, then Amazon should grow as well, as long as they stay competitive. So here's a very simple discounted cash flow model for Amazon, and we input the growth rates here. I went ahead with 25% for the next 5 years. They have been growing at something like 30% per year for the past few years, and while you could make an argument that they could keep that up for a while, I'm trying to be more conservative in my assumptions. 25% is still a monster growth rate for a company of this size. And frankly, no company can keep up 30 or 40% growth indefinitely, because eventually the company becomes so large that it basically encompasses the whole world. So I went ahead and assumed a 25% growth rate for the next 5 years, and then a 15% growth rate for years 6 through 10. So this is a 10-year analysis. I'm not saying that's actually going to happen, but this is just kind of a benchmark. I input my discount rate, which is 15% per year. So that's the return that I'm aiming to get with whatever stock I invest in. You can lower this or raise this based on your own risk tolerance and your own required return, but I use 15% so I can try to have a pretty big premium over the existing market returns that you might expect. Over the long term, that is, because if we follow historical trends, the broader market probably will return something like 7 to 10% per year. Again, assuming we follow history, which is no guarantee. I'm using a terminal multiple of 15. Historically, something between 14 and 16 is pretty typical for a kind of mature company. In this case, this is Amazon 10 years from now. We could definitely call that a mature company if all these growth projections pan out. And you might say, hey, those multiples are really low. Amazon trades for a huge multiple right now. Well, yeah, the market's pretty expensive. But that's historically speaking. Times are different now, right? I'm using a starting cash flow of $25 billion rather than the negative cash flow they would have from this year because of all the capital expenditures, because that seems like it's a fluke based on what's been going on. Again, I need to look into what those capital expenditures are. If it's just building out new plants or things like that, maybe it would actually feed into the growth rate. So maybe this is a reasonable assumption to go off of, but whatever, do your research is really what I'm trying to say. Besides the last year, the couple years before that, they were between a $20 to $25 billion free cash flow number. So we'll go ahead and go with that. For this excess cash number, I used their existing cash balance of about $30 billion, subtracted the capital leases and the long-term debt, which brings you to a net balance of negative $90 billion. I didn't count the short-term investments to just be a little bit more conservative, though it really wouldn't make a big difference in the grand scheme of things. When we take the initial cash flow and then multiply it by the growth rate over these years and then discount it appropriately using our discount rate, and then we take the terminal value of the business by multiplying the final year of cash flow by the terminal multiple, that gets you this terminal value right here, and then we discount that as well. We add up all of these things in the G column, and that gets you to $920 billion as the present value of future cash flows, which means when you add the excess cash, or in this case, the sort of excess debt, if you will, that would bring you down to an $830 billion market cap if you assume all of these assumptions will come true. But the actual current market cap is $1.45 trillion, so still significantly above what this intrinsic value would be. So you get a negative margin of safety, or a margin of danger, of about 43%, again, assuming these assumptions. And look at where these assumptions get them. This gets them to $150 billion in free cash flow per year by 10 years from now. To put that number in perspective, Apple currently has free cash flows of something like $90 billion per year. So you'd be significantly higher than where Apple is right now. And they throw off tons of cash. And if you think the growth rate is too low, okay, let's jack this up to 35% per year and 25% in the next 5 years. Okay, now you're at $340 billion in annual free cash flow 10 years from now. And now the stock looks like a great deal, but how reasonable are those assumptions? The company would be 3 or 4 times bigger than Apple is right now on a free cash flow basis. And maybe you think those assumptions are reasonable, but realize that a lot has to go right for that to happen. And a lot has to go right for a very long time too, for a decade in this case. But if we go ahead and lower these growth rates back down to where I had them before, this isn't an investment I'd be looking to make right now. And this is using pretty aggressive assumptions in my humble opinion, though maybe you think these are timid growth projections and you assume Amazon's going to be doing much more. Go ahead. Of course, beauty is in the eye of the beholder. We're trying to tell the future here, and there's no real way to do that. We're just trying to make reasonable assumptions, but only time will tell which assumptions actually end up being reasonable. I'm just going off the data we have today and my own assumptions. So am I investing in Amazon right now, even with the recent dip? Well, no, not at this time, unless something changes in the near future. We'll see what happens. I'll definitely be keeping an eye on it. It is a great business that I would love to own, but the price has to be right. And that's for any investment, whether it be a fantastic business or a not so fantastic business. I need to get it for the right price for my own risk tolerance and my own growth assumptions. If you're analyzing a stock in a similar way to this, maybe use a lower discount rate, and that suddenly makes it look like a much better deal. If you have a higher discount rate, something like 15% or higher, then maybe it doesn't look like a great deal. So a lot of things can change in how you analyze these things is really all I'm trying to say. But when in doubt, or if you're in need of financial advice, go and speak with a licensed financial professional. I am not one of those. But in any event, if you guys like this video, then definitely like it, since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And check out the free stuff and the affiliate links in the description below. But until next time, take care.